The US T-bill is created by the United States government, which is the financial instrument in the ways of the short term in the market. So that is created by the Treasury Department by United States governments, and the maturity period should not be more than 1 year for this instrument. So the creation of the US T-bill is because the United States government needs the funds in order to pay off the expenses. So therefore, the investor buy the US T-bills to lend the money to the government. The expenses by the government will be the salaries, the equipment fee, the military funds, and some sort of the expenses need to pay by the government. So the US T-bill also help the government in the way of to refinancing the maturity T-bills and also fulfill the requirements of the United States government of the needs to lend from the other party. Party involved in creating and auctioning the T-bills are the first party will be the Treasury Department from the United States. This is the department responsible to create and issue the T-bill to the party, and then they are also responsible to create and decide the auction information, the date of maturity, date periods, and also the amount for the T-bills that could be auctioned by the other party. And the next is the investor, and the investors are also involved in the parties involved in the T-bills, as their function is to participate in the T-bill auctions. So the investor could be the financial institution investor, the foreign governments, or the individual. Party of the financial intermediary will also participate in the T-bills. The institutions such as the investment bank, the brokerage firm, which are mainly functioning in the secondary market, will be the agent or the middleman between the customer and the seller in the secondary market. The next will be the credit rating institutions, which will help the investor in predicting and calculating the creditworthiness for the investor towards the assessment. The last party is the Federal Reserve, which means that the United States central banks, as their function is considered as the indirectly as the regulations and policies, the interest rate, the purchasing, and also the selling the T-bills in the open market. Next will be each party that will have their own rights in the T-bills. So the Treasury Department from the United States, that the department has the right and the authority in determining the durations of maturity periods of the financial instruments and the value of the T-bills and the specific of the information of options. So the investor, they will have two parties, which is buyer and holder. So the buyer will have the right to purchase the T-bills. As mentioned before, the parties can widely include the banks, the foreign governments, and so on. So while the holders will be the parties that hold the T-bills when they are successfully bid for the T-bills, and they could hold the financial instruments and until the maturity periods and receive the value of the T-bill. So the next will be the parties of the financial intermediary. So this party will participate in the secondary market as mentioned before, while T-bills are sold in the secondary market. So the next is credit rating institutions, that they are responsible for giving rating on the financial instrument, the advice towards the financial instruments, and then they will have the right in assessing the debt and also the cost in order to predict the risk of the instruments. And so the last will be the Federal Reserve, that they will have as the central banks of the United States governments, as they are the primary dealer in the process of the auctions. The responsible and the obligations that must be borne by each party that will have the Treasury Departments of the United States government. So they must be responsible for each of the issued T-bills, such as the information and terms of the T-bills, the maturity period, the face value towards the T-bills, and also the organizations of auction bills to the investor in the same times. So they will have to raise the funds for the United States government, and on top of that, the government should make the payments on time on the T-bill issues to the other party. So the next will be the investor, which the buyer are responsible for submit the bids if they are interested, and they have to set up the favorable interest rate of the price they are preferred to buy in the way of the competitive bids. So the next will be the party in the secondary market, which is require the responsible to react the T-bills in the secondary market whether they want to buy or not. So the next will be the Federal Reserve, which is the central banks of the United States. They will have to make the decisions of the market in order to manage the liquidity of the money supply in the market. The next will be the risks that might be involved for each party. So for the first party will be the investor. They will be involved in the risk of the interest rate risk, as the investor might be lose for the higher interest rate earned, as the T-bill is fixed rate instruments. So the investor will have the issues of reinvestment risk, that the interest rate might be lower than the interest rate auction at the first. So the next will be the Treasury Departments of the United States, which is the government might be facing the high payments cost if the interest rate is increased at the high rate. So the next will have the Federal Reserve, which is the central banks will also face the risk of the interest rate as they are holding the T-bills, which may face the same issue as the investor. So there must be have the benefit and also the reward for each party. So for the first party is the Federal Reserve, which is the central banks where will have used the T-bills to balance the money supplies and also by buying and selling the T-bills. So the short-term effect of the money supply will help the central banks to manage the interest rates in order to achieve the monetary objective. And the next will have the investor that they could get the benefit as the financial instrument is the low risk instruments for the investor to invest. Moreover, the T-bills will have the high liquidity, which is easily to sold and also bought in the secondary market. So the last will be the Treasury departments of the United States that will have the benefit of borrowing the funds at the lowest interest rate as they can need for the extra fund to pay off the expenses. So as mentioned before, the T-bill can be traded in the secondary market as much long as the maturity date hasn't been reached. So the selling and buying the price will be different as they follow the interest rates in the market. So in addition, the pictures of the Treasury Department between the Federal Reserve, which is the example of the process of purchasing the T-bills by the Federal Reserve, and then the T-bill can be buying and selling in the secondary market as before the maturity date comes. So in order to buying and selling the T-bills, there will have some ways for the investor to access the T-bills, which is the competitive bids, which is the ways for the investor that they already set the specific interest rate to bid the T-bills. So the lowest of the bid will be received and become the holder of the T-bills. So the second way is the non-competitive bids, which is the investor they are agree with the interest rates and the moderate yields of the T-bills, and then these T-bills will have preferable as the situations of the investor wanting to claim all the amount of the bill when it comes to the maturity date. So the next will be the investor could access in the secondary markets from the investment banks. So the person who has the access funds and has cash, or the party from the mutual funds and also the party from the exchange rate funds will have the interest to invest the T-bills in order to keep their money safe at the same time earn the interest. So the T-bill instrument is used in the Treasury Department by a bank as the investment instrument. So this is because the T-bills is the low-risk financial instrument which is reliable for the banks to make the investment on the instrument. So the instrument is valuable and worth for investing as this is issued by the government. Therefore, this is also good for the banks and to invest the T-bills in order to earn the interest income. So moreover, the T-bills is considered as the high liquidity instrument as it is easier for the banks to sell the T-bill in the secondary market if they needed the cash or the quick resource as well as before the maturity dates of the T-bills. So in addition, as the bank becomes the holder of the T-bill, it can be used as the collaterals in the situations of having to repurchase the agreements between the banks. By using this way, bank can minimize the credit risk and also secure the short-term funds by pledging the T-bill as the collateral. So furthermore, the T-bills is required in the bank as it can be part of the liquidity coverage ratio in the regulatory requirement. So the requirement of high quality liquid asset, which is HQLA of the bank, can be take the T-bill as the instrument in order to meet the requirement of the regulations. So the official guideline regulating the T-bills in the United States, it is under the management of the Bureau of the Fiscal Service.
Hello everyone, my name is Leung Wei-en. My trade number is 289528. Now I'll present about the US repo and reverse repo. So for the part 1, we consist of definition, purpose, who and how created. Definitions: the repurchase agreement, also known as repo, is a sales of asset combined with an agreement to repurchase them on a specified future date at a pre-arranged price. One party lends cash against the collateral of the other party. So while the reverse repo is to sell to counterparty with an agreement to repurchase that same security at a specified price at a specified time in the future. So this is the example of the operation and transaction repo between the commercial bank and central bank. Next is the opposite way for the reverse repo. So the next one is the purpose of the security is to financing portfolio or using cash as collateral to borrow security. Federal Reserve also uses instruments as a monetary policy tools to protect themselves against the decline in the value of the assets subject to the repurchase. Cash lenders typically require over collateralizations. So, New York Federal Open Market Trading Desk is authorized and directed by the Federal Open Market Committee FOMC to conduct repo and reverse repo transactions to support effectively monetary policy implementation and smooth market functioning. So next part is the part 2 is consists of the party. First party involved is primary dealer and eligibility. Depository institutions are the participant in US repo and reverse repo operations. Primary dealers are trading counterparties of the New York Federal in its implementation of monetary policy. Rights of party. New York Federal transact merely with regulated banks and broker or dealers do not pose an undue level of credit risk exposure to New York Federal. So they have some principle. They should participate competitively according to standards for participations. So the next one is responsibility of the party. So for the repos, they have to eligible to become a SRF counterparty. A firm must be a state or federally chartered bank or saving associations or a state or federally licensed branch or agency for a foreign bank. So for the reverse repo, they also must be eligible, so they can provide insight into the developments in the market. Counterparty should meet any minimum capital or other standards that are set by the primary regulator as they provide information. So the next one is the risk of the party. So they create the risk exposure for the security dealer to various market participants. So they expose the credit risk, legal risk due to the rules and regulation and collateral or trust. So the next one is the benefit to the parties of the instruments. They to manage the legality and funding source for current or future situation. Party who are in the short position and insufficient in liquidity may utilize the repo to obtain the short-term fund immediately. So the parties who are in the long positions and they can for the excess fund they can utilize these instruments to diversify their excess funds and gain some reward from them. So offer for favorable interest rate for seller and buyer, such as higher interest rate for seller and lower interest rate for buyer. So the borrowing cost of these two instruments are lower than others, as well as the process is easier and shorter. So next we turn to the part 3. We are the what is the price mechanism. Refer to the price fixing of the repos and reverse repo in US. Then the factor that impact the repo rates is the terms of the agreement, including the tender and pricing of the collateral and the types of security. So they have traditional and non-traditional method, and then the rates of interest each transactions are negotiated based on several other factors, including market condition, supply and demand of certain forms of collateral, and the credit quality of the underlying security. So this is a diagram of the repo rates mechanism. Between there are some parties, which is central bank, repo rates, commercial banks, and they will fix their price of the repo rate. So the next one is the secondary market. Yes, there is secondary market for US repurchase agreement and reverse repurchase agreement instruments. So the counterparty will sell and buy these instruments in the market, so that the money market will manage their current or future positions of their assets fund or their shortage of the fund. So they can borrow, also can lend out the these instruments in that market for the manage their liquidity. So the next one is the official guideline. They have a few official guidelines standing overnight repurchase agreement operation, a reverse repurchase agreement operation, standing foreign and international monetary authorities repurchase agreement operation, foreign and international monetary authorities reverse repurchase agreement, daylight repurchase agreement. And then the next one is the regulating agency. FOMC, Federal Open Market Committee, is responsible for the open market operation and also responsible for the regulating authority for these instruments, repo and reverse repo. Federal Reserve is responsible for the demand and supply of the balance of depository institutions held in the Federal Reserve Bank. So for the FOMC, they consist of 12 members, and then they will review their economic and financial condition, determine the appropriate stance of monetary policy, and assess the risk to its long-run goal of price stability and sustainable economic growth. So for the last part, we consist of the instruments. So first, how are the instruments traded? The market participant use these instruments to manage the money supply in the market, so serve as a backstop in the money markets to support the effective implementation of monetary policy and smooth market functioning. So this is the diagram shows that how the federal funds is asset use the reserve balance and the overnight repurchase agreement. So the next one is the where and how you can access these instruments. For the repo, you can access from the money markets that will offer by the Federal Reserve and the money market participants. And then for the reverse repos, they also the same things that will use by the SOMA for the portfolio to settle the instruments. So the instruments used instrument used in the bank treasury operation is a temporary operations either on the same day or different delivery basis. So you just purchase such eligible security subject to an agreement to sell, which is known as repo, and also the opposite functions with a reverse repo in a 65 business day or less at a certain rate. So they're also done by the Federal Reserve SOMA. They undertake these instruments to subject in the Federal Reserve Bank and maintain their customer account or foreign account. So that's all for me. Thank you.
Hi, good day, doctor and everyone. My name is Ng Chong Cheng, entry number 277603. Next, I'm going to explain about the US savings bond. Basically, the US savings bonds is one of the debt instruments issued by the US Treasury Department to borrow money from the public for a tenure of up to 30 years. The US savings bond is designed specifically for individual investors and can be easily found on the Treasury Direct website. There are two types of US savings bonds. The first one is E bonds that has a fixed rate of interest. On the other hand, the I bonds has an interest rate that is adjusted every 6 months according to the inflation. The US savings bonds is created for funding of the federal expenses incurred by the US federal government. Let's look at the situation at the right. The US government faces budget deficit once in a while. That means the total expenditure incurred by the US government is greater than the total revenue received, including the taxes received by the US government. In this situation, the Treasury Department has to issue Treasury securities, including US savings bonds, to obtain funds from the public. More specifically, the US savings bonds is one of the Treasury securities created to encourage savings and investments by individuals and families. The US savings bonds is created by the US Treasury Department, and more specifically is the Bureau of the Fiscal Service under the US Treasury that issue the securities to raise funds for the federal government. So the entity will conduct auctions at a predictable pattern throughout the year, and the auctions are conducted through online systems, and it will be monitored throughout the auction processes. There are two parties involved in the issuance of the US savings bonds. The first one is pretty straightforward. The US Treasury Department. They ensure the federal government has sufficient funds to maintain its basic functions and operations. Then the next one is individual investors. The individual investors need to have a Treasury Direct account to access into the auction process to buy the US savings bonds. The investors need to have a social security number or employee identification number in order to open a Treasury Direct account. That means they do not need to be a US citizen, but they have to be employed legally in the United States. Moreover, they need to have a registered address in the United States and also host a US bank account. Next is the rights and responsibilities of each of the parties. The first one is the US Treasury Department. The United States Code Title 31 grants the rights for the federal government to borrow money from the public. For the individual investors, they have the right to purchase the US savings bonds released by the Treasury through the auction process, and they have the right to redeem the principal and interest of savings bonds after 1 year, but they will lose 3 months of interest if the amount is redeemed less than 5 years. For the responsibilities of the US government, they have to follow the United States codes regarding all the processes regarding of the debt issuance. They also have to return the principal and interest according to the terms. The individual investors has the responsibility to provide accurate and precise information when registering for the Treasury Direct account. They also have to be aware of the terms and procedures of the auction and redemption processes to avoid any problems. Each party faces their own risks regarding the US savings bonds. The US Treasury Department faces the risk of rising interest expenses. This is specifically for the I bonds that have interest adjusted to the consumer price index every 6 months. This is due to the hiking of the inflation has caused the rising interest expenses incurred by the US Treasury Department. For the individual investors, the EE bond holders exposed to the inflation risk. The rising gold prices has eroded the buying power of the fixed interest received by the EE bond holders. The rewards for the US Treasury Department is performing their right to obtain funds, and the budget deficit issue is addressed. For the individual investors, they hold the EE bonds, and that gives them the safe and predictable investment yields. But if they chose to hold the I bonds, it gives them the to let them hedge against the inflation. Next, we'll talk about the pricing mechanism for US savings bonds. The US savings bonds are distributed through the auction process on the Treasury Direct. It is done on a non-competitive bid process, means that all bids are accepted, but the yield to maturity and the coupon rates are determined earlier by the Treasury Department. We will have a look at the current rates of the savings bonds. For EE bonds, the current rate is 2.7% for those that issued between November 1st, 2023 until April 30, 2024. It is of a fixed rate, so the EE bonds has a current rate of 2.7%. Then we'll have a look at the calculations for the I bonds. Currently, the rate for I bonds is 5.27% at the bottom there. So, to get this current rates of I bonds, we will go through a calculation of having the fixed rates and also inflation rates. The fixed rate is 1.3% plus the inflation rates of 1.97% that is used to hedge against the inflation. Then we will go through the formula for the calculation, and at the end we will get a composite rate of 5.27%. Okay, the US savings bond is traded only between the US Treasury Department and also the individual investor. This is due to that there is no secondary market and the US savings bonds cannot be transferred to other person. We can look at the figure. The purchase of US savings bond by the individual investor is done through the Treasury Direct, and the principal is paid to the US Treasury Department. Then they will obtain the savings bond from the US Treasury Department. For the redemption of US savings bond after a certain period of time, the individual investor can give back the savings bond to the Treasury Department, and in turn they will receive the principal and interest from the Treasury Department. Is there any secondary market for the US savings bonds? The answer is no. It is one of the non-marketable securities, and it can only be bought from the Treasury and cannot be sold to third party. Your name is already registered on the savings bond upon purchasing. The savings bonds is only for individual savings purpose and not for profit from trading, thus it cannot be sold to any third party. Where and how can you access this instrument? It is very easy. All the Treasury securities can be accessed from their official website, which is the Treasury Direct. You can go to the website and click Buy Direct and fill out the relevant information. Then the last one is the registering of the bonds on who owns them. It can be your family members or you buy for your friend. How does this instrument use in the bank treasury operation? Unfortunately, it's not possible for any banking institution to purchase savings bonds. It is only for individuals to buy it and also the families to purchase. Are there any official guidelines regulating this instrument? Yes. The United States Code Title 31, Part 351, and also the United States Code Title 31, Part 359 governs the offerings and also the stipulations regarding the US savings bonds. Who are the regulating agencies? The regulating agency Specifically is the Bureau of Fiscal Services under the US Treasury Department. So this agency governs and also determines the debt portfolio of the United States government. They also administers the savings bonds program that sells savings bonds to the individuals in the United States. So it is very clear that the Bureau of the Fiscal Services is the only department that governs the US savings bonds. Other agencies take part in very minimal aspects of the program since the secondary market is non-existent because the US savings bonds is non-marketable. That's all for my part. Thank you.
Good day, Doctor. I'm Jayalishmi Venkataramana. Metric number is 289717. I'm going to present for the next instrument, which is US Bankers Acceptance. A US Bankers Acceptance, BA, is a short-term financial instrument issued by a firm that is accepted by a commercial bank, creating a legally binding obligation to pay the specified amount at a future date. In addition to being an investment in the money market, it also serves as a method of payment in international trade. Any US bank that has been given permission by the Federal Reserve to do so can issue this banker's acceptance. They typically have maturities ranging from 30 to 180 days. US bankers' acceptance are widely used to facilitate trade finance and are considered to be a relatively low-risk investment due to the creditworthiness of the issuing bank. US bankers' acceptance is created for the purpose of providing short-term financing for commercial transactions. It is a financial instrument issued by a bank that guarantees payment to a seller of goods or services. This instrument is commonly used in international trade to ensure that the seller will be paid by the buyer at a future date. Who and how is it created? US bankers' acceptance is created by banks in the United States. The process of creating a banker's acceptance involves several steps, which are agreement, and the next step is application, followed by issuance, fourth step endorsement, fifth is discounting, and the last step is payment. There are three parties involved in US bankers' acceptance transaction. The first party is the issuing bank. This is the bank that issues the banker's acceptance and responsible for creating and signing the acceptance and is usually a commercial bank. The next party involved is the applicant. It is the party that requests the issuance of the banker's acceptance. This can be an individual, a company, or a financial institution that needs financing or wants to secure a payment. The last party involved is the accepting bank. This is the bank that accepts and guarantees payment of the banker's acceptance when it matures. This bank agrees to pay the face value of the acceptance on the specified maturity date. Rights of each parties. First, let us look at the rights of the issuing bank. It has the right to issue and sign the banker's acceptance, the right to charge a fee for issuing the acceptance, and the right to negotiate the acceptance with other parties. Next, the rights of the applicant are the right to request the issuance of the banker's acceptance, the right to use the acceptance as a form of financing or payment guarantee, and the right to negotiate the acceptance with other parties. Lastly, the rights of the accepting bank are the right to accept and guarantee payment of the banker's acceptance, the right to charge a fee for providing the acceptance guarantee, and lastly, the right to negotiate the acceptance with other parties. Next is the responsibilities and obligations of each parties. First, the responsibilities of the issuing bank are to carefully review and evaluate the creditworthiness of the applicant before issuing the banker's acceptance. Next, to accurately draft and sign the banker's acceptance document. Thirdly, to provide the banker's acceptance to the applicant within the agreed upon time frame. Lastly, to ensure that the banker's acceptance complies with all legal and regulatory requirements. Next, responsibilities of the applicant are to provide accurate and complete information to the issuing bank for the evaluation of creditworthiness. Second, to pay the required fees for the issuance of the banker's acceptance. Thirdly, to use the banker's acceptance for its intended purpose and in accordance with the agreed upon terms. Last one, to ensure the availability of funds to cover the payment of obligations under the banker's acceptance. The last responsibilities of the accepting bank are to carefully review and evaluate the creditworthiness of the applicant before accepting the banker's acceptance. Secondly, to provide a valid acceptance and guarantee of payment for the banker's acceptance. Thirdly, to charge the applicable fees for providing the acceptance guarantee. And lastly, to ensure the timely payment of the banker's acceptance upon maturity. Risk to each parties. First, the risk to the issuing bank are such as credit risk, fraud risk, and reputation risk. Risk to the applicant are counterparty risk, market risk, and non-payment risk. Lastly, risk to the accepting bank such as credit risk, liquidity risk, and reputation risk. US bankers' acceptance transactions offer several rewards and benefits to the parties involved. Firstly, for the issuing bank, in terms of profitability, the issuing bank able to earn income through fees and interest charges associated with the issuance of the banker's acceptance. Next, it helps to enhance the liquidity. By accepting the banker's acceptance, the issuing bank can convert accounts receivable into a negotiable instrument that can be sold in the secondary market. Last one is risk mitigation, where the banker's acceptance allows the issuing bank to transfer credit risk to the accepting bank and reducing its exposure to potential default by the applicant. For applicant, the US banker's acceptance provides a financing option for the applicant, allowing them to obtain short-term funds by presenting the acceptance to a bank or selling it in the secondary market. It also helps to increase its credibility. By using a banker's acceptance, the applicant demonstrates their creditworthiness and financial stability, which can enhance their reputation and facilitate future business transactions. Lastly, it provides flexibility in terms of payment and maturity, allowing the applicant to align their cash flow needs with the maturity date of the acceptance. Similar to the issuing bank, the accepting bank also able to earn income through fees and interest charges associated with accepting the banker's acceptance. Therefore, it provides profitability. Next, the accepting bank can invest in banker's acceptance, potentially earning a return on the investment through the interest paid by the applicant. This provides investment opportunities to the accepting bank. Lastly, risk diversification. By accepting banker's acceptance from various applicants, the accepting bank can diversify its credit risk exposure and spread its risk across different counterparties. The pricing mechanism for US bankers' acceptance is typically based on the discount from face value. The discount rate is determined by market conditions such as interest rates, credit risk, and liquidity. The price of a banker's acceptance is calculated by subtracting the discount from the face value. The discount is commonly quoted as a yield and is given as an annualized rate. The price can fluctuate based on changes in market conditions and investor demand. How is the instrument traded? US bankers' acceptance is typically traded in the secondary market through financial institutions, brokerage firms, and electronic trading platforms. It is bought and sold at a discount or premium to its face value, and the price is influenced by factors such as interest rates, credit quality, and market demand. Additionally, US bankers' acceptance can be traded over the counter or on organized exchanges such as the Chicago Mercantile Exchange (CME). Is there any secondary market? Yes, US bankers' acceptance is commonly traded in the secondary market. This market allows investors to buy and sell these instruments after they have been initially issued. The secondary market for US bankers' acceptance is typically facilitated by financial institutions, brokerage firms, and electronic trading platforms. Where and how can you have access to this instrument? Access to US bankers' acceptance can be obtained through various financial institutions, including commercial banks, investment banks, and brokerage firms. These institutions may offer US bankers' acceptance as a part of their investment products and services. Additionally, investors can access US bankers' acceptance through electronic trading platforms, over-the-counter markets, and organized exchanges such as the Chicago Mercantile Exchange (CME). Investors interested in US bankers' acceptance can also consult with financial advisors or investment professionals to explore available options for accessing and investing in these instruments. How does the instrument used in a bank treasury operation? In a bank treasury operation, US bankers' acceptance can be used in various ways. Firstly, it can be utilized by banks to raise funds for their own short-term financing needs. Secondly, US bankers' acceptance can be used by banks to provide financing to their corporate clients. For example, if a company needs short-term financing to support its working capital needs, it can approach a bank for a banker's acceptance facility. Overall, US bankers' acceptance serves as a flexible and efficient tool for banks to manage their short-term financing requirements and provide financing solutions to their clients. Are there any official guidelines regulating this instrument? Yes, there are official guidelines regulating US bankers' acceptance. Bankers' acceptance is a short-term debt instrument issued by a company and guaranteed by bank. In the United States, the Federal Reserve regulates bankers' acceptance through the Federal Reserve Act and the Federal Reserve's Regulation A. These guidelines ensure that the bankers' acceptance transactions are conducted in a safe and efficient manner, protecting the interests of both issuers and investors. The regulatory agencies for US bankers' acceptance include Office of the Comptroller of the Currency (OCC), The OCC is an independent bureau within the US Department of the Treasury that oversees nationally chartered banks, including those engaged in bankers' acceptance. Second is the Federal Reserve System. The Federal Reserve System is responsible for supervising and regulating state chartered banks that are members of the Federal Reserve, as well as the overall stability of the financial system. Third one is the Consumer Financial Protection Bureau, CFPB. The CFPB is tasked with protecting consumers in the financial marketplace and has the authority to enforce laws and regulations related to bankers' acceptance. The fourth one is the Securities and Exchange Commission, SEC. The SEC regulates and supervises the securities industry, which includes certain aspects related to bankers' acceptance. Lastly, the Financial Industry Regulatory Authority, FINRA. FINRA is a self-regulatory organization that oversees brokerage firms and their registered representatives involved in the trading or sale of the bankers' acceptance. That's all from me. Thank you.
A foreign currency swap occurs when two or more international parties come to an agreement to exchange interest payments for loans that are denominated in different currencies. It is an agreement that involves borrowing one currency and lending another currency at the same time at a predetermined date, and then switching the amount when the agreement comes to an end is known as a foreign exchange swap. FX swap created because it can be beneficial for a number of reasons. One of which the opportunity to acquire loans denominated in foreign currency at interest rates that are more favorable than those that could be offered by borrowing directly for a foreign market. During the year 2008, when a great number of developing countries were having difficulty meeting their financial responsibilities, the Federal Reserve offered them the opportunity to borrow money with the assistance of a currency exchange. There are three parties involved in FX swap, which are counterparties, corporate entities, and regulators. Counterparty is a person who needs access to another currency for a short period of time is referred to as a borrower. Next is corporate entities. Business operating in the financial sector has the ability to protect themselves against swing in exchange rates. And the last one is regulators. There are regulatory groups that maintain a close check on the financial markets to ensure that they are both stable and fair. Rights of each party. Counterparty is the one that make decisions regarding the national amount, exchange rate, maturity date, and any other relevant factors. Furthermore, during the negotiation process, corporate organizations have the ability to adapt the foreign exchange agreements to meet their specific requirements. Moreover, regulators may be necessary to impose restrictions about reporting duties, risk management methods, and opponents in order to keep the market consistently stable. Risk to each party's counterparties face default risk, which refers to a situation in which one of the borrowers is unable to repay the principal or interest on the loan when it is due. The corporation runs the risk of incurring financial losses as a consequence of fluctuations in the rates of exchange for different currencies. Plus, regulators don't have risk because of the amount that is being switched serves as a collateral for repayment. Rewards or benefits of FX swap. The party with the lower interest rate receives the points, while the side with the higher rate pays them. It is determined guarantees the exchange of one currency for another in the amount specialized. All these parties in rates, whether they are positive or negative, are rectified at the delivery date that was agreed upon throughout the negotiation process. It is traded during the course of an over-the-counter OTC derivative. Two parties engage in a transaction in which they agree to exchange currencies at a predetermined rate and then pledge to reverse the transaction at a later date. Cross-currency basis swap provide the power to exercise control over the spread that exists between different currency bases and to have an impact on the overall cost of the foreign exchange swap. Secondary market. It allows for the buy and sell of previously issued currency. It can trade foreign exchange swaps on specific online trading platforms. Using an integrated order book, these websites can bring together a large number of market participants to trade and deal. This instrument can access when the business can protect themselves against the chance of incurring losses as a consequence of variation in currency values. In addition, the bank's ability to buy and sell assets such as government or other financial institution issued securities allows it to control the liquidity of the system. All foreign currency swaps, options, and non-delivery forwards (NDF) are centralized by a derivative clearing organization (DCO). Trading in foreign exchange futures and other commodities and derivatives on the US market is regulated by the Commodity Future Trading Commissions (CFTC). Price mechanism. The discrepancy in interest rates that exists between two distinct currencies is the primary factor that is taken into consideration when determining the cost of a currency swap. Currency pairing that are more liquid are characterized by having lower transaction costs and a narrowed spread between the bid and the ask price. Responsibility or obligations of each party. Counterparty is responsible of settling the parameters of the foreign exchange swap through negotiations. Corporate entities will identify the term of foreign currency swap before entering into the negotiation with its counterparty. Regulators documents list forth the requirements for appropriate market behavior, transparency, and risk management. The cash flows or liabilities of two or more financial instruments are traded with one another. Currency swaps in the various forms were the first kind of swaps. The United Kingdom government imposed taxes on foreign exchange transactions involving the British pound. Transactions in foreign currency that involved the British pound were subject to taxation under the system that was in place under British government.